Short exercise 5-13. We're going to prepare merchandiser's statement of owner's equity and balance sheet. So it's going to be for the same company, Camellia Communications. So the company reported the figures from its adjusted trial balance and its multi-step income statement for its first year of business. So this is the adjusted trial balance, and this is the income statement. Prepare Camellia Communication Statements of OE for the year ended. Assume that there were no contributions. So contributions means investments. So there are no investments, no contributions, and no withdrawals. So they've chosen to leave those two lines off. And we're assuming that the business began on August 1st, 2023, which is exactly 1 year before this. Enter a 0 for any zero balances. Include only applicable transactions during the period. Assume that the capital balance shown in the data provided represents the opening capital balance of the business for the year. All right. So remember the formula for the statement of owner's equity is bind with an E. Beginning capital plus investments, which this company did not have, plus net income minus draw, which this company did not have, equals E, which is ending capital. So we need our beginning capital. So our beginning capital is where? Here it is. Camellia Capital, 4635. Copy and paste. All right, BIND. So we got beginning capital. I is investments. Again, there were no investments or contributions. N is net income. So we need net income. And we get net income from over here. 5735. BIND. D is withdrawals. And remember it says no withdrawals during the year, so they've left that off. And then that gives us E, ending capital. So 4635. And this is net income, so we're going to add that. So if you add those two, you're going to get $10,100 of ending capital. Let me move this up. Check my answer. Nice work. Now we get to work on the balance sheet. We don't need the income statement anymore. So prepare Camellia Communications classified balance sheet. So classified means you break up the assets into current assets and then long-term assets, also called property, plant, and equipment. And then liabilities would be split between current liabilities and long-term liabilities. So I begin by completing the assets section, then complete the liability. So we need to start with the asset section, and we always start with current assets. So now my accounting lab is not going to force you to list the assets in any certain order, but I'm going to list them in the order that they are usually done. First, it's cash, and then accounts receivable, because remember, assets are listed in order of liquidity. How fast will they be turned into cash or are already cash? So cash is already cash, so it's listed first. AR is usually due within 30 days, so that's pretty soon, so that's going to be listed next. And then third, we have inventory. Where's merchandise inventory? Because it's going to usually take longer than 30 days to sell the inventory. And then we have the other, right after merchandise inventory, we always list the estimated returns inventory. All right, so we got cash. Over here we got cash of $2,900. Let me move this over. Next we got AR, so where's AR? 3,200. Merchandise inventory, 1,000. And then estimated returns inventory, 100. So we're going to add this plus this plus this plus this. That gives us total current assets of 7,200. All right. So after current assets, we list our long-term assets, but no one ever calls them that. They usually call them property, plant, and equipment, or PP&E. So let's see what type of long-term assets they have. I don't see any yet. Here we go. Equipment net. Net means it's after accumulated depreciation is subtracted from it. And the amount we have is $9,500. I notice there's only one here. So then we're just going to have total property, plant, and equipment of $9,500. So then we're going to take 7,200 plus 9,500. That gives us total assets of 16,000, 700. Check my answer. Awesome. Now we've got, let me move this up again so we can squeeze more in here. Liabilities. So liabilities are going to be split up between current liabilities and long-term liabilities if they have any. Every company has current liability. So the first current liability that is usually listed is accounts payable, because that's due within 30 days usually. And next we usually have salaries payable, 1,200, because that's usually due within 2 weeks, because most people are paid every 2 weeks or so. Salaries payable. And do we have any other payables or liabilities? Here we go. Refunds payable, 600. All right. And again, my accounting lab does not force you to list these current liabilities in any certain order. So if you want to list them in a different order, you can. In the real world, if you're curious how your boss wants you to order them, you just get the previous year or the previous balance sheet. It could be quarterly or monthly or annual balance sheet. You just get the previous balance sheet and follow their formatting. So we're going to add these up, and then we're going to get total current assets, total current liabilities of 6,000, 100. Next we have long-term liabilities. Now let's see what type of long-term liabilities they have, if any. Here we go. Notes payable, long-term. So we have $500 of long-term notes payable. And then we've got this black horizontal line, which means we need to do some type of mathematical operation. So what we're going to do is we're going to do addition. We're going to add 6,100 plus 500 gives us total liabilities of 6,600. And then owner's equity, we have capital. Where's the capital account? There we go, Camellia Capital. And we get that from all the way up here from the statement of owner's equity, 1010. So I'm going to copy that, move this back up. So then what we're going to do is we're going to add, now remember the last line, and basically it's the formula for the accounting equation, is total liabilities and owner's equity. So the accounting equation is total assets, right here, which is 16,700, has to equal liabilities, here's my liabilities, plus equity. So we have to add these two up, 6,600 plus 10,100, and hope and pray that they equal this, because they have to. If they don't, then you've done something wrong. So let's see if they work. 6,600 plus 10,100 gives us 16,000, 700. So always double check. Do total assets equals liabilities plus equity. And they do. And that's it.